Morning, Carl. Brady, good to see you.
Good morning, Carl and the board. So we are here today to talk about Ashfield's strategy and what that strategy is going to look like going forward.
And the board. Carl, board members. Carl, comma, board members.
Okay. So Dungiven has provided an opportunity to create value and enhance Ashfield's strategy moving forward. So this strategy and what it'll look like is what we examined through running financials and through our qualitative analysis. So this qualitative analysis included the product mix, included the significant expansion of operations to markets that are currently not utilized by Ashfield Resources, as well as the company integration and culture that would come as a change to Ashfield's current existing strategy. As well, we examined the risk of renegotiated softwood lumber agreement and the sustainability of a combined entity. So given these areas of consideration, multiple major stakeholders were affected. So Ashfield shareholders and you, the board, who want to ensure that the $75 million purchase price paid to Bob is fair, and that existing shareholders are not left worse off as a result of the transaction. The Dungiven family, who wants to ensure that they are receiving a fair price for their company, as well as ensuring that their employees are left with job security and jobs moving forward. Employees of both companies are affected, as the strategy moving forward may not be what the strategy has been in the past. Usually in mergers, there's job cuts as a result of trying to gain the alleged synergies. So this can leave both employees of both companies worse off. Customers of both Ashfield and Dungiven would be negatively impacted by the failure of either company. The combined company must be capable of remaining a going concern moving forwards. So the three major criteria we sought to answer in this were whether the combined entity would provide more favorable job security, whether the combined entity would increase shareholder value, as well as would this shareholder value come as a result of, or without resulting in further dilution.
The technical analysis of this acquisition focused on three major valuation methods. First, precedent transaction analysis was used to evaluate Dungiven on a standalone basis to assess the fairness of the $75 million asking price. Based on our precedent transaction analysis, we arrived at a valuation range centered around $77.5 million, indicating that the asking price is in fact fair. One interesting point to note from this analysis is that Dungiven, when compared to the companies previously acquired, is able to operate and support its annual production capacity with a lower level of capital assets than other firms. Next, we moved on to a discounted cash flow analysis to value the combined Ashfield-Dungiven. The major underlying assumptions for each of our base, bull, and bear cases were centered around two major assumptions. The lumber price, which drives sales growth, and also the projected level of operating expenses and margins. Our DCF was given the highest weight in our calculation of an overall share price range due to the fact that we were able to hold the most influence over this model when it came to incorporating various risk factors such as the lumber price and the potential for a new softwood lumber agreement to come into play. Additional details of the DCF can be discussed after our presentation. Comparable analysis was used as a second method of valuing the combined entity. In order to conduct this analysis, we projected a balance sheet and income statement for Ashfield Dungiven and compared this to a list of competitors with West Fraser and Western Forest being given the most weight as they were the most similar competitors. The valuation was conducted using EV to EBITDA and price to sales multiples, given that the underlying data supporting these metrics was the most reliable and most relevant amongst all competitors. One major limitation that was identified within our comparable analysis is that it relies upon past or historical profitability data. This fails to address many of the concerns, such as the implementation of a new softwood lumber agreement in the near future. Overall, the post-acquisition share price range is estimated to fall within a range of $5.12 to $6.30. This represents an increase in shareholder value as a result of the acquisition, well over and above the current price of $4.50.
So bringing this together, what does this new strategy mean for the combined Ashfield-Dungarvan entity? This strategy means more job security for employees as a result of greater capacity utilization and greater access to markets and less reliance on the US market. It means an increase in shareholder value as this acquisition will see a share price increase in the range of 20 to 50%. It also means that there will be this increase without further dilution, as Ashfield, as the board, as you, are able to pull this transaction off without issuing shares through usage of debt and cash. So although the acquisition has its merits, management is now limited through the job security proposal to Dungarvan. So Ashfield's vision to become a respected and well thought of leader in the Canadian lumber marketplace, this has to be achieved without laying off employees, without further consequences. The further consequences of this could be not able to attract a talent or retain talent, as well as not being offered these friendly transactions moving forwards.
Following the close of the transaction, Ashfield must explore further action in order to ensure that this transaction represents a horizontal merger for competitive purposes rather than merely an investment in a competing firm. In order to do this, Ashfield ought to utilize surplus timber rights within the Kootenay region in order to increase capacity utilization. In addition, the company should explore the transportation strategy of the combined entity to best utilize Dungarvan's proximity to not only major transportation routes, but also major American customers. Failure to explore such action in the immediate term will cause Ashfield to lose out on some of the value that's generated by this acquisition. Over the long term, Ashfield should consider diversification of the company's customer base to include more revenue from customers located outside the US, specifically those within Asia. Of focus should be markets that are showing growing demand for BC lumber products, such as South Korea. Ashfield should be sure to leverage its existing relationship with part owner Mitsubishi to achieve this goal. Mitsubishi will be incentivized to participate in this action in order to increase or maintain the value of their investment. Diversifying your customer base will work to reduce not only the cyclicality of your revenues, but also your exposure to the North American market and any risk factors such as a new softwood lumber agreement. At this point, we would like to open up the floor to any questions that you may have.